Hi everyone, and thank you for joining the latest edition of our Community Bank webinar series. So our webinar today will discuss what community and regional banks are doing to increase their liquidity and improve their overall shareholder value. I'm happy today to be joined by Tom Dooley, Senior Vice President at BOENNING Scattergood. And in our work advising community banks on capital and liquidity issues, one of the more common concerns we encounter is how to deal with a changing shareholder base and attract that new generation of investors to your community bank stock. So we've structured our webinar today to provide you with the basic tools for you to understand where community bank stocks are traded, how they're traded, and who is trading them. Once you understand this framework of the public markets is when you can really build an effective plan to achieve your bank's own goals and really maximize the value of your bank stock. So we'll go ahead and get started with where are bank stocks traded today. When we look at the capital markets for community bank stocks, we can really break it into two large segments. We have the exchanges and the OTC markets. The exchanges include the New York Stock Exchange and NASDAQ, where about 400 of the publicly traded banks are listed. The remaining 600 banks are traded on the OTCQX, OTCQB, or Pink market, and are all operated by the OTC Markets Group. Over the past decade, the OTC Bulletin Board has really gone the way of the dinosaur from lack of technology updates. The banks that were formerly quoted on the BB are now all traded and quoted on the OTC Markets Group. There are several important differences and advantages to each of these markets, which we'll go into some more detail later, but I wanted to begin with some of their commonalities. Banks listed on either the OTC or the exchanges all receive the benefits of being publicly traded, whether it's the ability to easily raise capital, provide liquidity to your shareholders, and also to appear more favorable in merger or acquisition scenarios. Additionally, both the OTC markets and the exchanges allow investors and shareholders to buy and sell through their broker of choice, whether it's an online account like E-Trade or more traditional brokerage firm. These banks all have public tickers and no longer need to manage their own books and trade under the president's desk. So to walk us through how bank stocks are actually traded today, I wanted to introduce to you our guest speaker, Tom Dooley with BOENNING Scattergood.
Okay, so we're on the BOENNING and Scattergood slide, right?
Yes.
Okay, all right. So I'm in the Columbus, Ohio office of BOENNING and Scattergood. You can see a little bit of information about the firm there. Basically, we're 100 years old, and our specialty is trading community banks. We make markets in approximately 300 community banks, primarily in our market region, the Midwest and the Mid-Atlantic, but we do trade some, some banks all over the country. So that's a little about us. We go on to the next slide, Mary, or is that?
Yeah, so just to update everyone, Tom, can you not see my slides?
No, I see slides on here from OTC markets, but they're not moving. Now
okay.
They're fine. Okay. Basically, I've been in the business 30 years almost. Probably for the past 20, just trading community bank stocks exclusively. I would say probably for the first 5 or 6 years that I made markets in these stocks, I never met a banker. I never had to leave the office. There was incredible demand in everyone's local communities, and so it was kind of a different job than it is today. Today, you've got to spend a lot of time out in the market, learning about the markets and the local markets and what's going on there. So the job of trading these has certainly changed over the years. So a market maker, the generally accepted definition, if you look at the SEC, it's somebody who stands ready to buy or sell 100 shares of a particular security, and that definition's never changed. That's probably more than 50 years old, and so it really doesn't explain what a market maker does. People think a market maker just is there to facilitate transactions, and that's part of it. But with banks, with your banks, you've got several different market makers, and we're going to get into that. But a good one, the job is really to partner up with a bank and effectively help them provide liquidity for their shareholders and attract new shareholders, because the market is very, very inefficient for community bank stocks for most of them, and a buyer and seller just doesn't show up at the same time. And so it's our job to kind of get in there and be the facilitator and the intermediary and make sure things can go as smoothly as possible. So I've named my presentation here Market Making for Bankers, so I hope no one's offended. So this would be similar to the screen that a trader would look like or look at, or I would see, or even some of you guys, if you're QX banks, you would have access to this screen. And I'll just explain it briefly this time, and then we're going to go back and look at some other things. But if you look at the left side of the screen, you'll see the market maker ID, which is market participant ID. Those are just the market makers who trade this bank. This is Isabella Bank Corp, a bank in Michigan. We all have our little four-letter symbols. And then the bid would be on the left-hand side. That's the price. If you wanted to sell 100 shares, in theory, that's the price you would get. And it goes down with market makers with posting their different bids. As you get further and further away from what's known as the high bid, you'll see some of the bids are away from the market. I'm looking at this, and it says Wedbush is 17.25. That doesn't mean that he's actually trying to buy your stock at 17.25. It means at this time he has nothing going on, no interest, and so he's just kind of out of the way. But he's not trying to steal anybody's stock. And the same is true for the offer side of the market. Raymond James has stock for sale at $27.75. His lowest offer and my best bid would be known as the inside market. And the same is true for these guys who are way out of the way at the bottom. You can just ignore that. That's not it really doesn't mean anything. All right, Mary, if you go on. So, yeah, we all move around, and I get a lot of calls, why did my stock go down, or how did this work, or how did that work? And it's, I've tried to explain it over the years, and I don't know that I've ever come up with a great explanation as to, as to why things move around. But I was talking to a couple bankers a couple weeks ago, and I was trying to put it in banking terms, and so I came up with this idea, and we'll see if it makes any sense to you guys. So I'm thinking about, if you just had one business, and if you're buying and selling money, and this is a fictitious town with fictitious rates, and I chose, there are 4 banks in town, and these are the deposit rates, that would be like my bid. So Bank A is paying, 1% on deposits, Bank B, 110, and then you can see the rest. And then the banks are trying to loan the money out, so they have their different rates, which in my business would be the ask. So the best deposit rate out there is 110, and the best loan rate is 275. Let's go to the next stock, Mary, or next slide, excuse me. So if you think about it as a banker, if you don't have any loan demand, and you're the guy who was at 110, you're going to probably lower the rates that you're paying for deposits. If you've got great loan demand, you might raise what you're paying for deposits. If you don't have a lot of demand, you might lower, what you're charging for a loan. That would be the equivalent of me lowering the ask. If you go to the next slide. And the same way with demand. If you're anticipating good demand, if you've got some great lenders out there, you might raise your what you're paying for deposits, which would be like my bid, to try to attract those deposits so you can in turn loan those out. And so it's the best analogy I could come up with. If you've got great loan demand and you're raising your bid to get deposits to cover that, your pricing goes up. It's like your stock price going up. So I don't know if it's a great analogy, but it's what I came up with. So let's go to the next. So if we go back to this slide, first I'll talk about no demand or low demand in this stock. If some kid in your town inherited 2,000 shares of stock and he goes to E-Trade to sell the stock, and I'll talk about size here for a minute, and we're going to assume these sizes are accurate. I'll get into that later, but the first 100 shares theoretically he could sell would be at $27.67, which is the bid. If I bought 100 that level is exhausted, and now the new price is $27.66, and he would sell his 100 there, and so on and so forth, going all the way down. You can see where a couple thousand shares of the stock could push the stock all the way down to, in theory, that $17.25 price. And so when you're looking at your stock some days and the stock is down a couple of bucks and you can't figure out what happened, that's what happened. Poorly executed order, nobody in the marketplace really ready to commit capital or absorb that stock, and so they just bought their minimum, their posted size, and they just got out of the way. And you know, so that's why the stock is down. If you look at the other side, if there's great demand and you know, somebody's trying to buy 500 shares of stock, they'd buy Raymond James stock at 27 3/4, Knights at the next level, and then I'm at 29. That's my symbol, betting at Scattergood. And I'm not really trying to sell any stock. I'm trying to buy stock, so I'm kind of out of the way. But and maybe it's happened to some of you guys. It happens to a lot of banks at least once. Someone puts a market order in. I'm going to pick on E-Trade, but any online broker where there's no one to really, you know, settle somebody down or advise them that the computer is not the stock market. If this kid tries to buy 500 shares, all of a sudden your stock's going to trade at 29 bucks. And then you probably get a bunch of calls. But that's kind of how the market functions, and we'll get into some nuance in a little bit.
Yeah, definitely. I think that's probably the most creative way I've ever heard the bid and ask explained here. So I love the analogy, Tom. I always try to keep it relative to the audience. That's great. I also want to point out really quickly that this level 2 screen here is available to all the banks that trade on the OTC markets. It's available publicly for the OTCQB and OTCQX traded banks for your investors and shareholders to be able to see. And pink banks can access it privately through OTCIQ.com. So if you're ever curious to see what type of activity is getting played out in the stock, you have that available to you. And I definitely encourage you to reach out maybe to one of your market makers and have them walk through your screen with you as well, so you could really get a better sense and feeling for what these level 2 quotes are meaning and how to interpret them. But Tom, another topic that we see brought up often is with our banks is really their concern for overall liquidity and having a fair price for their stock. But I know that you have your insights to that as well, so I was really hoping you could walk us through what you've gathered from your years of experience and share some of your insights with us, and really what is liquidity and what is pricing for a bank stock.
Okay, so for price, you know, there's liquidity at different price levels. For price, we're just going to say, you know, assuming my stock trades at a level where there's room left for a new investor and someone who, you know, who's an existing investor can get out at a fair price. And that's kind of a key. That's where you want to be, wherever that is for your peer. And liquidity can, you know, if your average shareholder owns 2,000 shares of stock, can they make a phone call and get out of that 2,000 shares if they at one price? If they can, you know, you're somewhat liquid. If they can't, you've got bigger problems. And that's all great in the, you know, when it's 2,000 shares, but you know, when it's bigger, that's a problem. So let's go on to the next slide. So this is a peer group. I pulled 250 million to 550 million. I realize it's a little bit of an odd number, and I put in 0.8 ROA to 0.105 and 9 to 12 on the ROE. And for argument's sake, I'm going to say that means all these banks are about the same, and they're about the same size. But if you look at, say, KLIB and compare it to FFNM, and I know it's really small, but their numbers are close enough, and we're not looking at all their numbers, but they're, for argument's sake. But if you look at I say their numbers are performance numbers, but if you look at their multiples, you know, the Killbuck, KLIB, is trading at 147% of book, and FFNM is trading at 78% of book. And it's out of whack similarly for the PE. And so if you have essentially the same bank trading at these big numbers, what causes that? And in my experience, particularly for a community bank, is Killbuck, KLIB, is better at telling their story. They're not necessarily better at running a bank, but they've done a good job of, convincing their locals that their bank is worth owning, and so that bank trades at a much bigger premium. So at this level, it really has little to do with how well you're running your bank, and more with how you're telling your story or how the market perceives you. So let's go on to the next slide. All right, so here's a bank, and I'm going to talk about liquidity now. Here's a bank that trades on NASDAQ, and if we look at the volume, it's across the bottom, and it's really scrunched down small. But this stock might trade a couple thousand shares a day. If you look at the 4,000 is up pretty high. It probably trades close to 1,000 a day. But if you look at the days where there was big volume in this stock, and you would assume also on NASDAQ it must be pretty liquid. If you look at the big volume days, they correspond to these huge drops in price. And so I would say this is not a very liquid stock. This is a very illiquid stock where the market is not prepared to take any kind of volume, and the price acts accordingly. All right, so we go to the next one, Mary. Now, here's another one. This one is Southern Michigan Bancorp. This thing trades about 1,000 shares a week. So you would assume this, and this is on the pink sheets actually. You would assume the stock is very illiquid based on that profile. But if we look at some of these huge volume days, the stock doesn't move at all. And so that stock, I would say, is very liquid, even though it trades low volume on a daily basis. Just go on to the next slide, and we'll get into why that is in a bit. All right, Mary, go to the next slide. All right, so let's talk about a market maker and how they operate or how we operate. So we're not under any real obligation to commit capital. We're under no obligation to buy or sell any more than those little 100 shares, which is really an insignificant number, unless we're representing a customer order, and then we've got to buy that many. Some market makers are merely electronic communication networks that just represent a customer order. They don't commit capital. They don't think, they can't, rationalize, and so they're not a great provider of liquidity. And then a market maker, some market makers trade almost every stock under the sun, so they really can't have any more special interest in your bank than a salt and pepper company. And so it's, you get a bunch of market makers, but on your stock showing up, but you really don't have that many. All right, from the next slide, Mary. And so back to this liquidity with volume. You don't see a lot of volume, and you think it's not liquid, but you've got to understand why that would be for some community banks. And if you think about it, most of your bank is owned by people in your community, and so they're not turning the stock over. And so you really can have liquidity if you have a plan, you've taken a lot of steps, when there is a volume, and it doesn't matter that you trade 1,000 shares a week otherwise. Okay, go to the next slide. And here's just another example of a stock that does not trade a lot on a daily basis. Cortland Bank. You can see at the bottom here it trades, next to nothing, and then once again these big volume days, and the price of the stock holds up relatively well. So I touched on this a little bit. It's the characteristics of the community bank are a little different. They're owned by the locals. Usually their buys and their sells are not market driven, they're event driven. Somebody gets married, somebody has a child, somebody has a kid going to college, or somebody passes, and that's when the volume shows up. And if you compare another bank that might have a bunch of institutional shareholders, even though they might be your size, they're going to trade more. Well, these institutions, some of them have 40% portfolio turnover a year, and so there's volume that's just people getting in and getting out, and so you really can't compare the two. One doesn't make it more liquid than the other. All right. So what can you do to have some liquidity and have these market makers step up and buy your stock when when shares become available. That's really where your liquidity comes from. So there's a lot of things you can do as a bank to kind of prepare for that, and that's probably almost more important than the market maker side. If you've taken care of these things, then it's much easier for the market maker to in turn take care of you. So I don't know how many of you have a plan. A lot of banks do not, but these are some of the things that are very important. Do you think about maximizing shareholder value? I hear a lot of boards talk about it, and I know they know they're supposed to be doing it, but relatively few have a plan. Your shareholder bases are, they're aging. If the average community bank, 50% of your shareholders are 70 or older, and I read a study in England. I'm sure it's the same as over here. I guess about 13% of the people aged, 70 to infinity in that age group pass every year, and so you can kind of see how many shares, or you're going to, are going to come into your market every year just due to death. So, are you out, trying to identify these new people? Do you have a plan for that? Like, you're required to have plans for so many other things. Getting down to some other issues, embrace that you're truly publicly traded. Mary touched on this before, but I've called banks before and said, hey, I just bought some of your stock, and I'd like to get a little information, and the person tells me that we're private. We're private. It's just between us and our shareholders, and click, and that's the end of the phone conversation. In my world, private is 10 people. If you have 400 or 500 shareholders, even though you're not SEC reporting, you're indeed, in my book, very, very public, and you're not going to get liquid by hiding that fact. I think to explain to your employees, who you are and how this works, I think that's a good place to start. Another big area is shareholders and customers. Typical community bank, you might have 500 shareholders, and it used to be you called those guys up, and this share, you bought stock over here, and this other shareholder, he bought stock, but now they're all aging, and that's kind of a zero-sum game, and so that's a very, very small pool, and that same bank might have 10,000 customers, and that's the pool you need to access. And I know not all 10,000 are qualified, but some of them are. And if you if you do the calculation that I mentioned before about the people passing, you're going to figure out, wow, I really need 20 new shareholders or 30 new shareholders in a year, and that's something you can manage. That's a process. 30 is a very realistic number. That's one every other week, and almost. And so you kind of have to go at it like that. And so a lot of customers don't even know they could buy stock in the bank. And then I have other considerations for that are kind of for me or personal when I'm looking, am I going to buy this stock? Does the bank take my call? Do they care that I've committed capital and I'm taking a risk? I don't know if you know this, but if your market maker loses money on your stock, that's his money. And so that's that's very important. And so you don't want to go take a position in a stock where you're going to lose money, you're going to be tied up in a position for a long time. Is the bank shareholder friendly? Some banks are fantastically run banks. They're not so used to being shareholder friendly, and so that's a challenge because you're just shrinking the number of people who look at your stock. Does the board really get this? Is the board really out there, committed to finding new shareholders? I know it's a pain. I know that, you see these banks that are de novos, and maybe some of you are, and you think about how much work it was to go find those people to invest, and you need to stay in that de novo mode for a little bit when it comes to attracting new shareholders. So those are some things that as a market maker we want to know that our banks are doing, and why would we care? So the answer is 90 seconds. All right, we have 90 seconds when a call comes in and ABC Wirehouse wants to sell 10,000 of your shares. We have 90 seconds to decide if we're going to buy that stock. And so all these little separate pieces of information, we compile those as quickly as we can, and we figure it out. If we buy the 10,000 shares and commit the capital, your stock probably stays at wherever we were on the bid, those prices I was showing you earlier. If we say, geez, I don't know what I'm going to do with this 10,000 shares, I'm going to buy my 100 that I'm obligated to buy, then you've got you've got a free fall. The next call is the same wirehouse, and they've got 9,900 shares to sell. And if the next guy takes 100, it's 98, and it goes and goes and goes until your stock becomes so cheap, then somebody steps in and buys the stock, and it's probably a less desirable shareholder than you had in mind. Go to the next slide. So 90 seconds to review some of this stuff. How well do I know the bank? Is the bank properly priced? I don't want to overpay because I'm committed to these things. How did it go with the bank before? Do I remember they're a great supporter? Is the bank ever a buyer? Does the bank, will they help me? I call them up and say, hey, I've got this many shares, and we've had banks before. A bank a number of years ago in Indiana, we had $3 million worth of stock for sale. We tied the order up for a couple minutes, and the bank said, hey, look, we think we have this many names. We think we can buy this much at the end of the month if that's what we need to do, and we'll just work through it. And so we bought the stock, and I think we got the number down in about 2 weeks to something manageable, and the bank just said, you know what, we'll just take the rest. So I can tell you every time I see that stock, I'm a buyer. I remember that. I felt good about that. I made money. The stock didn't go down a penny. Everybody was a winner, and that was all because the groundwork was laid prior to that phone call. Then we have other considerations. Do I believe it's 10,000 shares? Is there another 10 behind it? How long am I going to have that capital tied up? If I have $1 million that I commit to trading these bank stocks, and I buy, $500,000 worth of stock, and I sit on it for a month, I just took a 50% pay decrease for that month. So it's sometimes it depends on what my capital position looks like. Is it a good use? Then I've got to worry, well, gee, the stock has only traded 500 shares a week for the past 10 years, just 10,000. Is there something I don't know? Did a big loan blow up? Is there, things like that? Is it a good risk reward for me? Has the order been someplace else? If I'm the last to know, maybe I don't want them. And then lastly, and this one's very important, if I buy your bank stock and I buy it at a right price, and I'm going to get stuck with it, if you don't have anybody in your community, if you don't care or whatever, now I've got to figure out what to do with this stock. And maybe there are buyers for this stock that you don't like. And so then we've got to decide, geez, I like Bill and his bank, but I'm kind of stuck with this stock. I might have to, sell it to somebody he may now want as a shareholder. And so that's another consideration. We would rather not do that because it affects our relationship with the bank, and you guys are all buddies, and that kind of news gets out quickly. So that's something you really don't want to do. So we try to avoid that. All right. So to make it fairly simple, we're pretty simple creatures. It's like Pavlov's dog. All right. We get the call, we see the position in stock. Real quickly, do I think, last time I bought this stock, how was my experience? I ended up buying the stock. I called a board member, he yelled at me. I sat on the stock for, for months. It looked like Oreo on my books, and I lost money. And so very quickly, I'm not interested. I'm buying 100. Or I think back, and man, this is fantastic. We figured this out, and the bank got a couple new good shareholders, and they put their plan into action. This was wonderful. The market didn't go down at all. And so that's really how simple it is, I think, in my opinion. So you can go to the next slide. So that is really where your liquidity comes from, in my experience. At 90 seconds, am I going to buy them? What am I going to do with them? And as a bank, you should already know if I'm buying them or not. If we've worked together and there's a plan, and we're talking from time to time, and I know how you're doing as a bank, and you know, I've got other buyers who buy bank stocks, and they're people you like, they're board members of other banks, and we have this report. I know what your plan is. You can be pretty sure I'm going to buy that stock, and something's going to be okay. If you know, if we don't have that, you probably know your market maker is not going to buy that stock, and you're going to be down a couple bucks, and then the phone calls start. So, you know, how well you perform, your ability to tell your story, and to make sure that you know, you're doing everything you can do to promote not just your bank but your stock. That, in my opinion, that's where liquidity comes from. That's, you know, I think it's as simple as that, and it actually has very little to do with the market and more to do with your market and what you guys are doing at home. So go back to the market makers a little bit. Four-letter words. Sometimes we get called other four-letter words, but I'm talking about the market maker ID. So that's, go to the next. But back to my example here again. So these market maker IDs are names for all the brokerage firms, and some of the things that I guess that you need to know. We kind of went over the size and the bid and the ask, but if you look at some of the market makers, ARCA, okay, they're an electronic market maker, an ECN. They just post orders. When they buy their 100 shares, they're gone. And so I've noticed on a lot of websites, in your investor relations site, when you list market makers, you guys list some of these ECNs, and they don't, as a person, they don't exist. Your customer can't call that market maker and get any information. It's just a computer. So you really can't count on those guys to support your market at all. Those would just be for orders that are already out there in the market. Then you've got some other big firms like Knight, NITE, and Collins Stewart, CSTI. They trade everything, and so they're going to be in every stock you look at, whether it's Apple or your bank. And so while they may see some volume or whatever, they're not really, typically not working hand in hand with you to find a good buyer. And then some of the other brokers on here are guys who specialize in community banks or have a big focus on that. And those are the ones that are more likely to reach out to you and try to establish some type of rapport. Mostly they're corporate brokers with OTC markets, so they're pretty easy to find. All right, go to the next. So other things you'd expect from your market maker other than posting a bid. You know, your market maker is the intelligence, they're the eyes and ears for your stock. They see the orders. They can tell you what's going on. You know, we've had people nosing around before for a big piece of a community bank stock, people I don't know, and so my first call is to the bank to say, hey, what's going on? We're getting a call, somebody's looking for your stock. So we're kind of the eyes and ears. The other thing we can do, we deal with a lot of banks. Sometimes we know what works and what doesn't work. You know, a lot of calls, hey, Bob's finding some buyers over here. He had a lunch and invited 50 customers, and these guys didn't know they could buy stock, and now they're buyers, and maybe you should try that. So there's a lot of information. You know, we promote independence. All these firms on here have investment banking arms just like we do. We have investment bankers, and they'd be happy to buy or sell a bank or merge a bank or raise capital. But from a market maker standpoint, it might take me a couple years to develop a relationship with a bank. And so we don't benefit if the bank gets sold. The best thing for me is if there's nobody ever merges. Every time somebody merges, I lose a customer. So it's in my best interest that you're liquid and fully valued, and so you have options. You know, and the other things are just, you know, is your market maker a support of the industry? Are they giving back? You know, they're making money in your industry. Are they also supporters of it? So I would think that's important. You know, over the years, I've become a lot of friends with the CEOs of banks that we trade. All right, you go to the next slide. So, you know, when I was a kid and I saw the movie It's a Wonderful Life, I thought it was a Christmas movie. I've since come to realize that it's a banking movie. And so I just, you know, we're going to get into millennials a little bit, and I'll talk about that. But, you know, a lot of people in your communities don't know that they can own stock in your bank. When they talk about the bank, they think Mr. Potter owns the bank. That's what locally owned means to some people, or Mr. Potter and his cronies. And so you probably have some untapped potential there for new shareholders and some business if people knew that actually other members of the community own stock in the bank. And so that's it seems very simple, but that's a big hiccup for a lot of people. So I wanted to touch on millennials mostly because it must be important, because every conference I attend is a seminar on banking for millennials. But I started thinking of millennials as shareholders, and you know, initially I own a lot of different community bank stocks, and initially I thought I'm doomed. If these millennials this is how I'm getting out, these are going to be my buyers, you know, I'll never get out of my stock. I'll never be able to retire. But so as I was digging around, I found some other information. So you probably all know they're born between 1980 and 2000. They're the biggest generation in U.S. history. I learned something new. There were yuppies and there were dinks. Now they're Henrys, and a lot of these guys make a lot of money. They're not rich yet, but you know, either by continuing to work or, you know, their parents passing, they're going to have money at some point in time. So I started thinking a little more about them as shareholders. If we go on to the next slide, I became a little encouraged because they are big supporters of local ownership. And your millennial might be, you know, the millennial who lives in your town, or it could be the millennial who used to live in your town and now he lives in Chicago but still wants to bank with your bank. And being locally owned is very important for those guys. They want to be more than a number. They want education. You know, they do want face-to-face if you know, if it's on their terms. They're highly collaborative. They seek out partners, people to educate them. There's this website, OpenFolio, where their goal is to make investing simpler. And these guys talk about these things and they chat, and that's where they're going to get their advice. And I'll tell my story in a minute. And then social media and mobile online banking are very important to these guys. But it's interesting, the fastest growing segment of people who use this stuff are senior citizens. And so, you know, you're not just wasting your social media budget on the millennials. So, you know, I'm thinking about this group, and they sound kind of familiar. They have a lot of characteristics as some of your older, same characteristics as some of your older shareholders. And I years ago, I bought a big block of stock from for some bank in Maryland, a little tiny bank in Maryland. And we didn't know what we were going to do with it. And one of the guys who worked for me called the barber shop in this little town. And he said, hey, I'm looking for guys who buy this stock. What do you know about this, blah, blah, blah. Well, the barber shop in that town was where people met and talked. We get 3 names from the barber, and these guys bought the stock, and a couple of these guys are still clients. And it goes on in the coffee shops there. And so with these millennials, they're doing a lot of the same things. They're just doing it differently. So there is hope as far as that goes. We have a live millennial on the line here. You could,
yeah, definitely. So I guess as the resident millennial on the webinar today, Tom, I would like to say you brought up some really great points. You gave us some credit that I feel has been due for some time. Millennials really have had this stigma that they are self-absorbed. They're always on their personal devices instead of interacting with what's directly in front of them. But it really very much is that misconception. Millennials are similar to that great generation, and they do place that emphasis on connecting with their communities and have that sense of belonging. It's actually just amplified and done through different matters, and if anything, it'll just get larger through the use of technology and networking platforms. So like confiding with those in the barbershop, millennials also trust actually their social network for investing advice. Surveys have actually shown that over 80% of millennials are using user-generated content when they're actually making those purchasing decisions. So that's why we see platforms like OpenFolio that are cropping up where interested investors can actually go to find and discuss these new investment opportunities. So really when we look at this group of investors, as investors, there are a few items I think we should really keep in mind here. Other than the fact that we are not rich yet, thanks Tom, there's an important concept definitely to remember here, and that's also that millennials have witnessed really over their lifetime 2 major recessions. And although they were not directly impacted, they've seen the negative outcomes from that financial crisis. The loss of their parents' savings, seeing them not be able to retire at the age that they had planned for, also seeing their grandparents coming out of retirement and going back into the workforce. So this environment, to an extent, has really shaped the millennials to be rather risk-averse when it comes to their investment decisions. And they have also demonstrated that they do have less trust in these wealth advisors and these large banks. So they're much more democratic, and they really use their peers to benchmark their portfolios. And they're typically passive investors. And they also really want to see that social benefit and not just that economic one. So to me, and to the point that Tom made, this is a really great match for our community and regional banks. What we need the community and regional banks to do is to really make that commitment and to get that story out there and make sure you are getting noticed on those social platforms. And to Tom's point, making sure that your millennial customers don't see you as Mr. Porter from It's a Wonderful Life. So there's definitely a lot to consider when you're starting to make these strategic plans and looking at it in terms of how are we going to attract these new investors. So when your management team and your board are discussing your own strategies for the shareholder succession, the market you're traded on is really the backbone to a lot of those plans. You want to make sure that your market is giving you the best framework to support those initiatives. So while you're evaluating where the stock is traded, keep that in mind. Remember who it is that you're looking to attract. When we look at the 3 main markets for bank stocks, OTCQX, NASDAQ, and the pink market on OTC markets, we really need to focus on what is it that this market is providing you. Is it giving you the right framework? Is it giving you the right discipline? This new group of investors, they're online, they're social and data-driven. Is your bank stock online and data-driven? Is it easy for these investors to access that? Both the OTCQX and the NASDAQ will support that demand. So then you also have that decision in terms of cost. How does it connect to that? Does the bank want to pay on average $150,000 to $300,000 annually to be on the NASDAQ and then in addition also be SEC registered? Or is OTCQX a better fit where they can use their existing reporting that you're already providing to the bank regulators and pay $20,000 a year? The other item to keep in mind is remembering who and how your bank stock is traded. Are you a better fit for the matching engines at trading that we see on NASDAQ, or would your bank and would you prefer to work with a market maker to provide that liquidity and be able to manage your volatility a little more so on OTCQX? So I wanted to also have Tom talk a little about this so we could get a trader's insight when you guys are making those decisions.
I'll go quickly here because I'm watching the clock. But first of all, NASDAQ, I grew up in this business while NASDAQ was, growing, and it's a fantastic, exchange or medium. It's driven a lot of innovation. It's the market of choice for, some of the biggest companies in the world, particularly tech companies, Google and Apple, and some of the top banks. And so there's no dispute it's a fantastic place to be. But the big question is it a fit for a thinly traded community bank? And that's something you have to decide for yourself. I won't go through the whole thing here, but one of the scary things to me, world's fastest stock market. Participants gain orders and gain confirmation in 1/5 of a second. You're not going to get a lot of personal help there. That's a little bit fast. And so the way the orders are handled on NASDAQ, people who want to buy your stock kind of already have to be there. They already have to have their orders in place. So that buying decision is made long before they put the order in. With a typical community bank, the reason you have it's traded on the QX or someplace else, that time or that ability to take down a position and show it to somebody, that's what creates that liquidity. Maybe you had a farmer in your community who who wanted to buy some stock, but he never thought about it. But now he gets a call and there's 10,000 shares available. He's going to buy that stock sometimes. Farmers, by the way, are our biggest holders of community banks. If, you know, he's not going to put an order out there for 10,000 shares typically. So it is a different type of market. So I just wanted to touch on that. You know, if you know, some of the things to consider if you're already on NASDAQ. What do your institutions think about your delisting? I would find out. But be prepared to have a full-time IR person or firm. You know, road shows, meet with investors. All these are good things. It's just where are you in your life as a publicly traded stock, and so that's really what to consider. Are there banks that should be on NASDAQ? Absolutely, absolutely. But you have to make sure it's you, because if you're on too early, you will have, in my experience, you will have less liquidity. You will be paying a lot of money for not a lot of benefit. But if you're there, you know, and you're big enough and you're going to have the volume and do all these things, then by all means, it's something you should consider. Like I said, where are you in your life cycle? Okay, you go to the next one. And here I just put we'll just do Fifth Third slide. I put a picture up of Fifth Third Bancorp, and you can see on the size, you know, those are customer orders, 3,000, 3,100 orders. Those are already loaded up in there. And so after those orders are executed or those limits are exhausted, it goes to the next person. It doesn't really leave any time for someone to say, well, you know, Bob over at the hardware store wanted some stock. Let's show him these 3,000 shares that are rolling around. Those shares are gone. So it's a different market. So, and we can skip the other slide. That was not, it's more the same. All right.
Yeah, thanks, Tom. So you definitely brought up some really good points that banks need to be considering when they're looking to really engage their shareholders and how to access new shareholders and really how to better position yourself and tell your story in the capital markets. It could be NASDAQ for some banks. It could be OTCQX for other banks. It really depends on where your bank is at. And I do encourage all of you to reach out to your market makers and ask them what their insights are. Do you think we'd be better on NASDAQ or on OTCQX? Myself and my team here, we're happy to have that conversation with you as well. I want to just take a quick minute to take a look at this example of Harleysville Bank based out of Pennsylvania, just over $750 million in total assets. Harleysville is a bank that in 2012 took advantage of the Jobs Act, which actually lifted the shareholder of record threshold, allowing banks with less than 1,200 shareholders to now deregister from SEC reporting. This was also recently expanded now through the FAST Act to our savings and loans as well. So after Harleysville deregistered, it recognized immediate savings from reporting costs, corporate governance overhead costs, and of course the listing costs themselves of trading on the NASDAQ market. And their shareholders are actually able to see that and benefit from that immediately by getting that increase paid out to them in their dividend payments. Harleysville, if we look at this chart here, then joined the OTCQX as one of our founding member banks when it launched in 2014. The OTCQX banks market was designed specifically with banks in mind. So the structure that's in place there for those banks, they're following the rules and the requirements to trade on OTCQX. They're also positioning themselves to attract new investors and also support their market makers in all the ways that Tom has brought up today and suggested that banks really consider. So with that, I do want to save some time for questions, so I want to thank everyone for joining us. And I hope now that you have a broader knowledge base of who trades your bank stock, how it's traded, where it can be traded, and how you are going to structure your plans to plan for the future as well. Tom, if you have any last thoughts, I'll hand it over to you for now, and then we can address some of the questions that came in.
No other thoughts. I appreciate you guys taking time out of your day to listen to what we had to say, and look forward to your questions.
Okay, so Tom, a pretty general question that came in though, but a very great one. How often should a bank be in contact with their market maker?
You know, we make a habit of you know, we try to call at the end of the, you know, when they release earnings just to see what's going on. If their stock's active, you know, there's some guys we talk to a couple times a week. There are guys whose stock, you know, might trade a couple times a month. We might not hear from somebody for a month, and that's okay if there's nothing going on. So there's no, you know, in the beginning, you talk a lot so you get to know one another, and you kind of get to know what's going on. So there's no, you know, there's no hard and fast rule. I guess depends on how much the stock trades. The other thing, a lot of times too, we'll have board members as clients, and so we're getting additional touches that way as well. So, but you know, any contact is welcome contact.
Perfect. So another pretty specific question here for you, Tom. Individual investors are resistant to opening new accounts with a market maker that they are not doing business with. What do you tell individual investors looking to buy or sell a sizable chunk of shares for an
The first thing we do is apologize, because we know it's not like the good old days where they could, you know, where they could buy it in town. So we understand that's a problem. There's a couple ways, not around it, but to work through it. We have a lot of people where we realize we're strangers in this town, you know. So if a great start is if a bank has a transfer agent. If you have a transfer agent and someone opens an account with us, we will make every effort to work back through that transfer agent and get those certificates physically delivered to the customer or put on the books of the transfer agent, whichever they want, and close the account. We really don't do any business other than bank stocks. We're really not interested in calling somebody and talking to them about a mutual fund. We want to sell. We want to provide liquidity for banks, and so we try to get that certificate delivered out. If you don't have a transfer agent, it's tough, because DTC charges $500 for a stock certificate, and I hear it's going to $1,000. So and we don't get that money. That goes to DTC. So we do that. We'll be happy to buy the stock and transfer it to a local broker if they have a local broker. But we, you know, whatever the customer wants to do, you know, we're going to try to do that, because we recognize we are essentially guests in these communities, and so we will, you know, work very, very hard to make sure that they're very, very comfortable, and you know, they get the certificate where they want the certificate.
Okay. And just to keep under time here, I'm just going to finish with one last question here for you, Tom. So this question is focused around directing their shareholders to really buy and sell through a broker and not necessarily through them directly. So it's an OTC company, traded bank, and they're asking, our shareholders still come directly to us when they want to sell. How can we encourage them to go through our broker or our market maker?
You're going to have to go cold turkey. I mean, there are a lot of advantages for the bank and the customer, obviously, to continue to trade locally. But I just don't think it's a good policy. You have no, you know, the buyers aren't exerting any upward pressure on the price of your stock. You're assuming a lot of liability. I think if you kind of explain some of that stuff to the, you know, to the shareholders, that you know, most attorneys I know advise that the bank should not be doing it. I've never heard anything about the regulators. You know, I don't know what their view is one way or the other. But it's, you know, it's a tough conversation to have, you know, and it's a lot of changes that I can understand a bank doesn't want to go through. You know, they're going to need a transfer agent. They're going to have to list their shares. But it's, you know, just trading yourself is just not very efficient. How are you getting a fair price? How are you're just too close to the transaction. But there's no good way to transition out of it, but keeping it local, there's a lot of bad things that can happen.
Scare them into it. Sure. Good, perfect. Well, if anyone has any other questions, feel free to reach out to Tom. He'll be happy to talk to you directly about those. His contact information is here, as is mine. This, again, will be shared with everyone following the end of the presentation. You should have an email from us with this information included within the next few business days here. So thank you, everyone, again. Thank you, Tom, for sharing your insight. It was very valuable, and I'm really glad we were able to give you this platform and an opportunity to speak to a lot of our banks. I think you shared some really great information for them to really improve their market.
Well, thanks for having me. Sorry about it was probably operator error in the beginning with the computer. I'm sure it was me. But, thank you.
Yeah, that was the Millennials' fault, Tom. Don't you worry.
Bye.
Okay. Bye, everyone. Thank you.
Thank you.